All right, we are going to get started today to be conscientious of everyone's time. So once again, good afternoon. My name is Amanda McCord and I'm a YPN ambassador. Welcome to YPN's Fall in Love with Your Finances. We're so excited to be here, but before we get started, we want to give a big thank you to our YPN program sponsors, Gibson and Indiana Michigan Power, for their support throughout the year. Throughout today's event, if you have a question, go ahead and type it in the Q&A section at the bottom of your screen, and we will do our best to get to that. And as I stated, my name is Amanda McCord. I'm the branch manager for Centier Bank's downtown South Bend location. I have Kevin Fautz with me here today, and he'll be presenting right alongside with me. So I'm going to let Kevin introduce himself and kick off our presentation.
Well, good afternoon, everybody. Like Amanda said, my name is Kevin Fautz. I'm the branch manager for Teachers Credit Union on Ireland Road and the Meyer 331 location. Been in the financial industry about 8 years. Also volunteer with Junior Achievement on the board, do volunteer in the classroom. So financial literacy is certainly a passion of mine. So we go ahead and kick things off.
All right.
All right, so why are we here today? And Amanda and I had talked about doing this. I don't have any concept of time at this point with COVID going on, but I feel like it was within maybe the last six or 12 months. And we kind of talked about things that YPs would benefit from as far as from a financial perspective. So most people don't like talking about their finances. And the truth is, some of us just maybe don't know who to talk to. Maybe we're uncomfortable talking about it with spouse, friends, family, but it is something we do need to talk about. It's something that can lead to it can lead to stress in every facet of our lives. It can affect our career, it can affect our social life, and even our physical health. The average American is in debt about $38,000. And if making those minimum payments, that's going to move the needle really slowly for you. So we're going to focus on some things with budgeting and savings that's going to help you get out of that debt a little bit quicker. So we'll give you a brief budget overview. We'll start with what is a budget. So a budget is income and expenses for a given period of time. And when we talk about income with budgeting, we talk about the net income that we have. As nice as it would be to have our gross income, unfortunately, there's things that come out, taxes. Well, it's fortunate. I mean, there's health insurance, 401k, but we want to make sure that we're focusing on that net income to build our budget. Then we're going to want to talk about why do we need a budget, and that provides us an understanding of our current financial picture. So managing and improving our personal finances are very achievable goals. And then when do we use a budget? So we use a budget regularly or to plan for a specific financial goal. Budgeting will help us live within our means. And when you budget, you really create a clear picture of where your money is going. You can then see where you might be spending too much and change your habits in the future. Budgeting helps us pay down debt, which we'll dive into a little bit more later. And then it also helps you prepare for the future and emergencies. And if you plan for those unexpected things, you don't have to put those things on maybe a high interest credit card. So how do we build a budget? And step one is getting organized. Lay everything out. I was talking to Amanda last week about this, and I'm a paper person. I have to write everything down. So for me, getting organized would involve taking a kitchen table or a desk and just spreading everything out and then arranging it appropriately. Next, you're going to want to come up with your income and your expenses. So that's step 2 and 3. You're going to want to separate those things, and income is going to be the money that you get from your employer, maybe a side job that you have, any kind of hobbies that generate income. And then your expenses are going to be obviously housing expense, such as mortgage, rent, your car payment, electric bill, water bill, cell phone bill, anything like that. Step 4, and this is different for everybody, it's listing your savings goals. Some people might be saving up for a down payment on a home. Maybe you're saving up for a new vehicle. Maybe you're planning for retirement, planning for child's college expenses, things like that. And last but not least, it'd be listing your debts. And those might be student loans. Maybe you currently have a mortgage, car loan, credit card. Maybe you even finance some furniture from a store. You want to get some new stuff for your home, and you finance those through the store. So you want to list all of those things out as well.
And with that, you want to make sure you also remember annual expenses. So if you're paying your car insurance every 6 months or once a year, don't forget about that as well.
So next we'll talk about a couple different budgeting methods. The first one is the 50-30-20 method. So that 50 is going to refer to no more than 50% of your income should be spent on needs. Needs are going to be housing, groceries, your utilities, transportation, maybe a car payment, insurance, health insurance, medical needs. Honestly, internet and even cell phone you could put as a need. It's pretty hard for a lot of us to function in our jobs or just outside of our job without a cell phone or internet. Next would be the 30% on our wants. Wants would be that morning cup of coffee, maybe going out to eat at lunch, entertainment, salon and fashion. As you can tell, I go to the salon regularly with my hair there. And then last would be the 20% of income on savings and debt repayment. So those can be kind of what we referenced with your step 5 in building the budget. That can be your credit cards, student loans, anything left over in that bucket would be savings. And maybe that can go towards an IRA that you have set up, or maybe even putting that back towards your 401k. Next is the categories method. The categories method is a much more detailed breakdown of the percentage and the categories. So similar to the 50-30-20 method, which we talked about, the 50% was for needs. We have housing, utilities, groceries, transportation, which kind of made up the 50%. This is broken down a little bit further. So this allocates income according to the need of a person or a household. By thinking about the specific categories you spend money each month, you can predict how much of your income will be left over. That leftover money can go towards savings and making adjustments to meet your goal. With this categories method, things can be easily adjusted. If maybe you don't have any debt right now, which I applaud you if you're in that situation, and you can allocate that 10% somewhere else. Maybe you're not a person that dines out very often, you can allocate that 5% somewhere else. So the benefit of this categories method is you have a lot of wiggle room built in. You can move those percentages all around. Obviously, just want to make sure it equals 100% at the end.
And how you calculate the percentage for each category is you're going to total up all your expenses, let's say for housing, and then you're going to divide it by your net monthly income, and that's going to tell you where your percentage stands with that category.
And just using the budgeting solution that works best for you. There's really no one size fits all for that. So there's different types of budgeting. There's the envelope system, and that is literally where you label different envelopes and you use those envelopes to make your purchases. So you might have an envelope labeled housing, you might have one labeled groceries, and when you go to the grocery store, you would use that particular envelope to make your purchases. So it keeps you, I guess, kind of honest, maybe would be a good way to say it. Next would be an Excel sheet. I personally love Excel. I utilize it personally, professionally, but utilizing Excel gives you that ability to create formulas. You can add fun colors. So when you're doing well. Maybe it's a bright color. If it's an area of focus, you can kind of just navigate it that way. There's also quite the variety of budgeting apps, which before Amanda and I started, I searched within the App Store budgeting apps. Just countless different applications are available out there. So find the one that best suits your needs. It looked like most of them were free. There might be in-app purchases, but I don't know if you have one that you use, but definitely recommend using something like that to help you budget. So some strategies that you can use to help free up funds, and then we'll go over this little monthly budget we have here. First thing you can do is cut expenses. Find areas that you can cut out various monthly expenses. Take a good look at your wants and how much you're spending on things like eating out, and just make some small changes where you can, and find an area that you can cut. Next would be reducing spending. Take a look at other expenses or needs. Can you reduce your grocery bill? Maybe by meal planning, shopping at a discounted grocery store, and even cutting coupons. A lot of coupons are electronic now, and they attach to a card that you use at a store. I know there's plenty of grocery stores that you go on their app, you select the coupons you want, and it automatically takes it off of your, I don't want to say frequent shopper, but kind of your linked account to that store. Price shop for different services. If there's a repair you need in your home, maybe get a couple different estimates as opposed to just going with the first person you find. Shop around for those good deals. Evaluate your car insurance and your homeowner's insurance. Have a chat with your agent, make sure you're covered properly. And maybe you can even look around to see if there's a better deal out there if you bundle some things. Think about your current employment status, your skill set in the job market. Maybe you're coming up for a pay increase. Would you be better, working in maybe a different field within the same company or a different company altogether? Or is there something you can do to increase your marketability? Maybe getting an additional certificate or a license within your field, and that can help you broaden your ability there. And we kind of talked about this earlier. Consider freelance or some kind of side gig. If you're just looking for some supplemental income in addition to your current job, consider looking for some kind of side thing that you can do, maybe even in your field, and that might free up some funds as well as generate some additional income for you. So up on the screen there, we have a personal monthly budget example, and you can see up at the top, it's got the income, it's got the extra income, and then the total monthly income of the two, of those two. So then you're going to break it down, but it's got broken down by housing, transportation, food, entertainment, loans, and then your savings. You're going to want to really evaluate this and make sure one of those methods that we talked about earlier fits your needs, and just kind of plug and chug these numbers in here, whether it's like with an app or using an Excel spreadsheet.
And with the budget, it's definitely as extensive or as minimal as you want. You just want to make sure you're listing everything, but you can combine categories if that's what works for you.
So what are we saving for? And a lot of people think of emergency fund as maybe this really daunting or challenging goal. But the fact is only about 41% of Americans can afford a $1,000 emergency from their savings account. That was pre-COVID. I haven't seen a current statistic on that, but I would say it's probably still in that ballpark. We'll go on the next slide, we'll go over how you can plan for an emergency fund. But next, contributing to your retirement fund. If your employer offers a company match, definitely suggest taking full advantage of that. If you're only contributing 3%, but they match up to 4%, you're literally leaving free money on the table. So make sure you take advantage of your employer's company match if it's offered. Maybe you're saving for a new car or down payment on a home. And then you'll kind of want to determine, is that something you want to do in the short term, a medium term, or long term? And short term is going to be fairly soon, so within the next couple years. Medium term would be a couple years to 5 years down the road, and then long term is more than 5 years out. So if you're still, maybe new in your field, you're still paying down some student loans, and you're renting an apartment, and you want to purchase a home in a few years, that would obviously be a medium-term goal for you. And then you need to also ask yourself, do you need access to it? So that's why we always encourage people to make sure they have emergency fund. You want to make sure you have something in place if something unexpected happens. If a appliance fails, you need to repair at your home, car repair, you want to make sure you don't need to tap into your savings. You want to have that emergency fund kind of separate. Different methods of savings offer varying degree of liquidity, so you want to make sure you're avoiding a penalty. And if you do need to access it, you need to make sure you're asking those questions. So a couple of goals, emergency fund and vacation fund. I think I could speak for all of us when I say a vacation fund is probably a must. With the last 12 months, I'm sure many of us are eager to just get out and do something fun and exciting. But we'll use the emergency fund as our first example. So let's say you want to build an emergency fund of $1,000 over the next 12 months. You would need to save roughly $85 a month to come up with that $1,000 within a 12-month time frame. If you want to break that down to a different level, that's about 21-ish, 22-ish dollars a week. And when you're thinking of, man, how do I come up with $1,000? That's much more challenging than, okay, I can set aside $21, $22 a week. That's literally cutting out maybe a few cups of coffee in the morning, or a few, cups of coffee in the morning, maybe a lunch or two during the week. So it's something very doable. Maybe you want to save for that vacation fund. I would prefer a vacation in the next 3 to 6 months, but I'll be realistic and say 18 months is probably a good time frame to plan for a vacation. You break that down, it's about $135 a month, and you'll be on that trip to Florida or wherever you want to go. So there are strategies to saving money each month. Just make sure you're making a habit of savings. Decide on an amount you'll save each month and stick to it. When you do that, you'll make sure that you're sticking to the money that you're saving. Using automatic savings, that's a plan where maybe you put a little bit of money each month into a savings account, and it's automatically transferred each month. And this will just help ensure that you're meeting your savings goals each month. And then make sure you're limiting your spending. Spending less can make your savings goals much easier, much more attainable. So just try to cut back a little bit here and there when you can.
All right, we're going to move right into falling out of debt. And that topples right in with budgeting and savings. So first off, the biggest thing is to make that decision to be debt-free. Control your spending, which is where that budgeting and savings tips are going to come in, and then pay as much as you can afford each month. A huge tip of advice with this is delay some wants and only focus on your needs while you're working on paying off debt. That way that excess money can go towards that. And then as you pay down that debt, you have more money available to put towards that vacation fund or towards that emergency fund that you are working towards. All right, so there are 3 types of methods that we like to suggest using when it comes to the debt reduction strategies. The first one being the Snowball Method, and that one's focusing on the smallest balances first and then paying those off, and then using that money that you would have been paying for that one small balance, snowballing that to make it into a larger payment for those other things you're trying to pay off. The second one is going to be the Debt Avalanche, and that is paying down your highest interest debt first, and then moving to the lowest. And then the third recommendation is consolidating debt into one loan. With this, always talk to a trusted financial expert to determine what your savings would be when it does come to that.
We didn't pick those names. It's just how, I know it's cold and snowy out, but they are called the Avalanche and the Snowball Method.
And with those, once you decide which method works best for you, and you have your budgeting and savings goals, you are going to want to make, if you can, extra payments each month. You will never get penalized for making 2 payments on a credit card or a car loan, anything like that, if that's your goal to pay it down faster. And then if you receive unexpected extra income, such as taxes, overtime, or a yearly bonus, you can also put that towards paying down your debt. And on this slide, you can see that we have a little house and 4 tips to help reduce that mortgage balance and pay that down faster. First, you can pay your mortgage every other week instead of once a month. By doing that, that actually breaks it down to overall 13 payments, which that's going to help you pay down faster. To do this, we recommend talking to your lender, and they can help you set up with that program. Round up your payment. So if your payment's $1,013 a month, if you can round it up to $1,030 or $1,050 a month on a regular basis, that can help you shave off years of your mortgage. And then one thing that's been very big in the banking industry this year is refinancing to a shorter term, or just to pretend it's a shorter term. So by making that a shorter term, you're obviously going to mess with your monthly payment. So you do need to keep that in mind, but that can help you pay it off faster. If you can't shorten to that 15-year term, calculate what it would be, and then make that monthly payment when you can. And then when you're considering refinancing, make sure there's a significant difference in the rates, and then make sure to consider closing costs, because if it's not effective for you, you don't want to follow that method. And then the last one's going to be making 1 extra principal payment per year. This can assist you with savings on what you would be paying on interest. And you can do that by either making 1 large lump sum payment at the end of the year, or you can split that payment, divide it by 12. So for example, let's say you had a $200,000 mortgage and your monthly payment's $1,013 a month. You could divide that by 12, which would be an additional $84 per month on that payment. And over the course of the loan, you would actually save $27,571 on that, and knock off 4 years and 3 months on your 30-year mortgage. And then I did see a question, so I want to stop and grab that. All right, we will circle back to those actually, so we can cover everything. We don't want to miss everyone's. But lastly, with paying down debt, make sure to celebrate those small wins, and keep in mind your goals, and give yourself grace. If 1 month you can't make that extra payment, that's okay too. That's where that budgeting comes into play, and then you can restart that next month. So now we're going to flip to credit, and credit plays an extremely important part with getting jobs potentially, loans, mortgages, cars, you name it. So your credit report is going to tell who you are, how much debt you have, your payment history, and if there's negative information on you, or if you're being sued. So there's 3 primary credit reporting agencies that the financial institutions use. They're Equifax, Transunion, and Experian. And with that, your score is going to range between 350 to 850, depending on the company's scoring model. Your credit report has the following items listed on it. It's going to show us any installment loans. So auto loan, a home loan, personal loans, payday loans, student loans, or anything that you've signed on with anybody. Even if you are divorced, the fact you were on that loan, it'll show up on your history. It's also going to show all credit cards and revolving debt. So we consider that to be business credit cards that are personally guaranteed, credit cards, home equity lines of credit, and then public records such as bankruptcy, judgments, tax liens, or collections. And then any inquiries, so credit pulled for lending purposes for any company. And then if your employer, insurance, or insurance company did a soft pull, it'll show that, but it's not going to affect your score. It's also going to show your personal information, your name and any past or current names, your address, your date of birth, your social security number, and your employer current and past. Things that typically do not show up on your report are going to be utility, insurance, cell phone or medical payments, land contracts or rent payments, checking and saving account balances, your income, your race, gender, religion, or national origin, or your driving record. However, some of those may pop up if you've gone into default and a collection agency's reported that. So with credit, let me move to the next slide. Okay, so with credit, it is your buying power. So the benefits to having the higher scores is oftentimes lower interest rates, longer repayment terms, and lower monthly payments. When you have a lower score, it can put you in a higher interest rate, shorter repayment terms, and higher monthly payments, which ultimately results in paying more interest for the life of the loan. And as I stated earlier, it scores from 350 to, sorry, I'm drawing the blank, 850. 350 is going to be the worst. We consider fair to be about 590, and then 740 and above is going to be excellent. So just keep that in mind. And one way you can continue to monitor that is each year you're able to pull a free annual credit report. This is an example of the paper copy to be able to request it. However, you can also go to the website, and I do have that on, I think, the next slide or two. Super simple. You fill out your information, and it's going to give you copies of Equifax, Experian, Transunion, and we recommend pulling all three at the same time, just to make sure everything matches, and you're wanting to look for discrepancies on that. And once you receive them, you will want to make sure there's nothing off. And by that, date of birth being off, social security number being off. If there's a line of credit or credit card that you're showing on your report, that's not one that you recall, you can dispute that. It'll also show you what payments were made and what were missed. So the next slide.
I'm just going to add one thing. The credit bureaus, Equifax, Experian, and TransUnion, they're actually really good to work with when you do have a discrepancy. They are there to make sure that your information is accurate. So if you do have that discrepancy, if something's showing late or inaccurate, they're actually very willing to work through those things with you. So don't be afraid to question. They are literally there to make sure that the information on there is correct.
And I will jump off of that. So like we said, you get a free annual credit report yearly, but anytime you're denied credit, you are also able to look at that credit report and see why that may have been happening, and to look through and make sure all the information is correct. So this is an example of what a TransUnion one would look like. And I apologize, some of the wording is smaller, but we break it down into 8 sections. That top one, you're looking for verification of your name, social security number, addresses, and phone number. And a lot of times if somebody has your social security number or phone number wrong, that's where you're going to see it there. B, that's going to show your confirmation of previous employers, their addresses, titles, and dates of employment. And then C is going to notify you and the lenders any notification of civil judgments, tax liens, or bankruptcies. Part D, that's going to pop up if there's suspected fraud on Social Security or suspicious address. E is going to be the overview of financial status. F is going to show any unpaid bills. So that's what you're looking for to make sure that everything's paid up to date and on time. G is going to show the record of credit and payment patterns. And then H shows other credit employment inquiries, such as a soft pull when you were applying for that job. And if you're unsure of how to read these, reach out to your trusted financial advisor. And they can help read through, but it's important to pull it yearly just to make sure there's no discrepancies, especially this day and age where we know fraud is running rampant. And then tips to keep for your credit and to keep it strong. So like I had just mentioned, you want to monitor your credit report regularly and pay your bills on time. When you're missing those bills, that's when it's going to affect your credit score and your credit history. The National Foundation for Credit Counseling reports that recent activity on your credit report is actually more important than past mistakes. So if you were 18 and you stopped making that credit card payment, that's not going to be as big of a deal if you're 28 now and they're seeing that you're paying consistently on everything you have. And establish a steady record of repayment to help resolve past due accounts if you do have any that are overdue. And then another key tip is don't max out your credit. That'll actually decrease your score. They typically recommend to keep your revolving credit to less than 30% of your total available credit, or the credit limits that they do give you with those cards. Creditors and lending institutions consider your credit utilization ratio when deciding to grant credit or raise credit lines. So if you needed a larger line of credit for a credit card and you're maxed out on everything else, that's something they're looking at when they decide to either deny or approve that request. And then keep track of the length of your history. That's important as well. So FICO says the length of your credit history accounts for 15% of your overall scores. So don't close those accounts that you've had for a longer time. You don't need to use them, just keep them open. So it shows that you do have that history with them. And then minimize your risk of identity theft. Protect your personal information, because when people do get a hold of that, that's when we can start seeing stuff pop up on your report. A big thing is keeping the financial information or any social security records, shred those, make sure that information's blocked out before you're getting rid of them.
When it comes to keeping track of your or the length of your history, if you have a credit card maybe that you haven't used for several years, just put it in a little safe at home, lock it away in a drawer. That credit history that you've built for several years is definitely reporting in a positive way. So don't just call the company and close it out. If you have multiple cards, that's probably a separate conversation. But if you have that one card that you just don't use often, but you've had it established a long time, make sure you keep those open because you want that positive history reporting to the credit bureaus. I was going to add Credit Karma. I think Credit Karma, the scores I've seen are kind of all over the place. Sometimes they're 50 points low, 50 points high. I've seen where they're within a couple points. What I would encourage everyone to do is if you are using that, that's a good source to at least look at your report and at least make sure the information is accurate. So while the score may not be perfect, the information within the report can be valuable. Also, if you ever want to add a credit freeze to any of the 3 credit bureaus, you can do that. Indiana is one of the states that there is no charge for that. You can literally search Equifax credit freeze and they will walk you through the steps on how to do that. The good part about having a credit freeze is you still have all the good reporting to the credit bureau, the bad would report too, but it would keep someone that is trying to maybe steal your identity from obtaining new credit. Excuse me. Jeez. Sorry. They wouldn't be able to get it because you have that credit freeze on. So it's a free service through the 3 credit bureaus, definitely something to consider.
All right, so I'm going to stop sharing my screen and we're going to get over to the questions. Okay, so Frank, you said, let's say I'm graduating this semester. Can you type and elaborate on that for us, please? Oh, okay, I would like to move out once I get a position in my field. However, I only have 3K to my name and due to COVID, I'm unable to get any hours with my current job at school. Would I be restricted to renting once I move out, or are there other ways for me to go about getting a home?
Good credit score.
All right, and it looks like you've got a good credit score. So will let you take that one, Kevin.
Okay. I think, if you have a few thousand saved up, I think that's definitely a good start towards getting something established for a down payment on a home, and definitely with where your credit score is. I don't know if everyone can see that, so I'm not going to broadcast that, but your credit score is certainly good. I think you're definitely on the right track. Be restricted to renting once you move out. I don't think there'd be restrictions once you moved out. I can't think of any. If your score is that good, I always say someone that has a 700 or above credit score, they've been doing all the right behaviors. Someone south of that, there's kind of just a story to be told. You might be heading your way up, or maybe you just had some hiccups in the past. So, yeah, I think where you're sitting, Frank, is pretty darn good.
All right, and then let's see. Okay, for viewing your credit, what about Chase, TurboTax, and other companies that offer you to view your credit score at any time? That is a great question and a very valid point as well. So those are going to be a good ballpark range for you, but so for Chase, or I have a Citi card, that's just based off of their numbers. They're not necessarily looking or pulling from the three main agencies that we're wanting to look at. So while we do recommend it's nice to look at and put you in a ballpark range, I've seen it at times where it's 50 points or more off on somebody's score. So just keep that in mind, but it is good just to use as a ballpark when you're unsure about that. Any advice on talking with a spouse, loved one about finances when you might not be on the same page? That is a huge one that can really lead to strain when you are talking to a spouse or loved one about that. Go in calmly and definitely schedule a time to talk with them about it. You don't want to blindside them with it. And bring the finances, what's bothering you, figure out those same or shared goals. And find out what works for you. So some people have their own checking accounts between their spouses, and then they have a shared one, and then all the bills are paid for and they can use their money individually for what they want to use. But really go in calmly, and also circle back around yearly or quarterly, depending on what your lifestyle needs. And anytime there's a big change, so you are getting married or you're having a kid or your second kid, financials are definitely going to change at that point. So sit down and have that conversation again.
And I think just like any other conversation you would have with your spouse, just having an honest and open conversation. Sometimes it can be hard to hear maybe what the other person, says, but just kind of keeping that open mentality of, okay, you're coming from this viewpoint, I'm here, just trying to come up with maybe even something in the middle. Saving for a vacation is something I think a lot of people would want to do. So maybe that can be kind of a shared goal that you have. So, yeah.
All right. Does checking your credit score often ever hurt your credit score? So, Kennedy, what are you referencing when checking? All right, I'll give you a few minutes to type. We'll move on to, okay, FICO for Discover app. So that's not going to be a direct hit to your credit. That's a great one just to monitor and see where you are. So I look at that about once a month for myself, just to see if there's any dips or if it raises. I know it's not going to be accurate, but it's also not hurting my credit. Just like when an employer does a soft pull on your credit, it's not going to ding you at all.
It's similar to when you're shopping for a home or you're going to multiple dealerships looking for a car. If they see that your credit's being pulled by various institutions, they'll be able to kind of decide, okay, that makes sense. You're shopping for something. If it's done kind of in a short amount of time. If you start pulling it, once a month, every other month, that might be that might have a issue with your score. But if it's in that short period of time, if you're shopping for something, you're not going to see a major impact.
All right. My 401k allows for individuals to be used for a down payment on a home. Is this a good idea, or should I save up the money outside of my 401k to use? That is a great question. So I think a lot of that answer is going to depend on your need for a house at the current situation, and what your financial goals are down the road, because 401k is extremely important. You want to definitely keep that money in there so you do have a nice cushion when you retire. But if a house is an urgent matter as well and you don't have the time to save up for that down payment, you could also do that. Okay.
Sarah, thanks for the additional info. Yeah, I mean, I'm kind of agree with what Amanda says. I think there's a little bit more involved there. We could certainly speak to you maybe more individually on that. It is a really good question. If there's not a penalty for withdrawing from your 401k, it's certainly something to look at. I don't know if that would be my go-to personally. I think saving up, in some sort of different savings vehicle might be best. That doing that though could be right for you. Very good question. If your 401k is performing very well, tapping into that may not be the most advantageous thing, but again, there's a few more variables in play with that question.
All right. In terms of savings, is there such thing as too much being kept in a savings account? If so, what would you do with the extra? That is a great question as well. You guys are coming up with awesome questions. Honestly, that's going to depend on your personality type. For me, there's no such thing as too much being kept in my savings. I won't keep too much in one specific savings. And if it does get to that threshold, move it into, or look into moving it into a CD or money market, something where your money is actually working for you. Would be my best bit of advice with that, but you need to pick that dollar amount that you're comfortable with. So that goes back to budgeting and savings. So you could even create a 3 or 4 different savings accounts: short-term, long-term, vacation, and emergency. And then you determine that threshold. And then from there, that's how I would recommend taking off and deciding what you want to do with that excess cash.
And if you do run into that where you have extra, kind of like we talked about earlier, make sure you can max out your 401k too. Contribute to that if there's a match in play, or just kind of contribute as much as you can to that, or a separate retirement account even.
All right. Can I increase my credit score by paying everything? My credit score by paying everything on your credit card, then pay it all off on the next due date, or should I pay off a charge on my credit card before the due date? So I've always been told to pay it down. You can do it before or after, before your due date if that's how you want to pay it, but always, I was told if you're trying to raise your credit, you want to keep a minimum of $5, so it shows that you're making those payments, but you can also keep that little bit of debt on that credit card, if that makes sense.
Yeah, I think anytime I think you're also asking if you pay it off before the due date, you also won't have to pay interest on it, so that's a benefit. And definitely I would say more paying it down, kind of like Amanda was saying, leaving a small balance on there would be definitely a good way to help increase your credit score. You want to show that you're using it and that you're a responsible spender.
Yeah. And then once you get to your ideal credit score, you get it in the excellent position, then if you're just wanting to charge, let's say, to get those points that credit cards offer, and then you want to pay it off completely, definitely go for that. But while you're building your credit, definitely keep a small balance minimum on there each time. How long does it take for soft hits and hard hits to come off your credit report?
I believe it's
2 years.
I believe it's 2 years.
2 years.
Yeah, I believe the credit bureaus show inquiries for 2 years.
Are the only ways that our credit gets dinged when being checked is through Equifax, Transunion, and Experian?
my knowledge. Yeah.
We think it is. Let us follow back up with you, but typically we have those 3 reporting agencies. And then I recently purchased a car and I am able to pay off the loan I obtained in its entirety, but I was advised it would negatively hurt my credit if I did. Can it hurt my credit to pay it off? Yes, that unfortunately can lower your credit a bit. It shouldn't be a massive ding. So if your credit is in a good position or you don't need to apply for any type of credit for a bit, you could definitely do that if you want to free up those funds for something else in your budget or to put towards savings.
I'm going to circle back to Ernesto's real quick with the ding. So Ernesto, if you're referencing like an inquiry on one of those 3 bureaus, if the lender that you're using uses Equifax, for example, it would only show an inquiry through Equifax, not TransUnion or Experian. I don't know if that's exactly what you're asking, but hopefully that helps. And if not, we can address another one.
All right. And then if I pay off all my credit cards and keep it open and don't use them for a few months, will my credit score be affected by increasing or decreasing? That's a 2-parter. So let's address the first part first. If I pay all my credit cards and keep them open. So it can affect it if you pay it off all in one large lump sum. I've done that personally and it did take it down, I think like 3 or 4 points, which I was not concerned about, but you just keeping them locked up in a vault or safe that is not going to affect it unless you use it again.
And remember, about a third of your credit score is built off of your payment history. So if you're not paying on it for a few months, in essence, you're not paying it poorly. So I mean, it would have a positive effect after a period of time.
Yeah. So depending on what you're wanting to do, if you're trying to build your credit score, we would recommend having a small balance due on whatever you're comfortable with, because you do want to show that you can make that monthly payment on time and consistently.
How can I roll over a retirement account with an old employer to my new employer's retirement account? I would assume someone in your human resources department could assist with that. We both work at financial institutions, so I'm sure with Centier too. We can have one of our internal advisors kind of help us with that. I would assume, Sean, if you're not employed with a financial institution, that would be something your HR department might be able to assist you in coordinating. But that's certainly a good thing to do. Just kind of have it all under one roof, and then you don't have to worry about that previous employer.
Right.
Okay, so it looks like Ernesto's got to follow up with that.
Okay. So the question, it's a statement and a question. I suppose I was asking if it would lower my credit rate if a lender, even myself, checks into my credit through said reporting agencies, if I am looking to pay off a car loan faster, would making a larger payment or even a double payment negatively affect my score?
So that second one, it's not going to negatively affect your score. Once it's paid off, it's just kind of gone. So that good payment history is gone, but it wouldn't affect you super negatively. I don't know if I'm phrasing that right, but so I mean, although that payment history is kind of gone and you're not continuing paying on it, it's still good because it shows that you paid it off and you were, in essence, responsible with your borrowing.
And then I recently invested in mutual funds through a financial advisor. I then heard that the fees associated are not worth it. I have always heard mutual funds are great to invest in. So this is a shocker. Thoughts?
So I'm not a licensed advisor, so I'm not going to dive too far. However, I will share that typically, even within your employer's 401k, there's fees built in. Typically with your mutual funds, you're getting a higher return. So there's probably going to be some sort of fees associated with it. And in your case, you're absolutely right. It might not be worth it. So like Amanda mentioned earlier, there's other vehicles. There's certificates of deposit with financial institutions, money markets. Savings account rates are pretty flat right now, but there are other vehicles within the banks and credit unions that we can assist with.
All right, I'll give it a few more minute or so to see if anybody else has questions. Looks like they're all getting cleared out. Oh, all right. To clarify my last question about keeping all credit cards at 0 and not using it, if I do not use them and they're all at 0, my score will not go up because there's no activities, correct? So it would stay more steady throughout the course because there's no activity with that credit.
Yeah, I wouldn't say it wouldn't go up. It's certainly not going to go down if you have it out there. Now, if you have a large quantity of cards, if you have several open cards, if I'm looking at that, that might be an indication of that's a lot of potential debt. So, yeah, hopefully that kind of helps. I think that's where he was going.
And if you think of any other questions after this, you are more than welcome to reach out to Kevin or myself. The chamber does have our information. I know Amanda, she can definitely give that on, and you can reach out to either of us. We're both more than happy to sit down on a Zoom call and talk that over with you. So I don't see any more questions coming through. So we ended a few minutes early today. Go ahead.
If this is something that your employer you think might benefit from, I'll speak for Amanda. Either of us would be more than happy to come in and give a brief presentation to any team members you may have. So please keep that in mind. This is a passion for, again, I'll speak for both of us, that we really enjoy doing. So keep us in mind if there's ever anything we can assist with.
All right, and there's another question. So do student loans impact positive or negative with credit scores, assuming I am making on-time payments? So it's going to definitely affect your credit score as long as you're making those payments or you put a pause and you're not just letting those payments go to the side. They're not going to affect you negatively. Per se, that can go into a whole different spiral with debt to income though. But just for credit, as long as you're making those payments consistently, it would be a positive impact. All right. Since there's no more questions, I just want to say thank you everyone for attending, and thank you again to our partners at Gibson and Indiana Michigan Power. Make sure to register for our YP at 4, our virtual networking event on March 4th. While we may not be able to gather in person, we still want to stay connected with everyone. We're also working on getting a calendar populated, so keep your eye out as we get more events posted. Thank you for coming, and everyone have a great afternoon.
Thanks, everybody.
Thank you.